Hello and welcome to Mayor Brown's Energy Transition webinar series. My name is Kirsty Massey and I'm an Energy and Projects Partner at Mayor Brown based in London. The topic for discussion on this webinar session is battery and storage in the UK and Europe. And I'm absolutely delighted to be joined by Tom Harper and Sumit Joshi, both from Baringa. By way of brief introduction, Tom is a director in Baringa's Energy Markets and Analytics team. His advisory work is focused on helping investors, project developers and policymakers understand markets in terms of flexibility. So that includes market modelling and market design and transaction advisory work. Tom has worked on battery storage projects since 2015. Alongside other forms of power market flexibility, including merchant interconnectors. Sumit is a senior manager in Baringa's Energy Markets and Analytics team, and he is focused on energy market advisory services to investors in storage and other flexibility technologies. He's got over 10 years of experience in distributed energy across the entire project life cycle, so everything from feasibility, development and financing to commercialisation of distributed energy assets. So I can think of no two better people qualified to participate in today's discussion, and I'm really delighted to welcome you both. So thank you. So in terms of just sort of setting a bit of background to all of this, I think it's fairly clear now that batteries and storage are really quite an important part of any low carbon energy system. So as we get more renewable generation on the bars, with the intermittency issues and the grid challenges that brings, batteries and storage become particularly important. I understand from what I've read that we've got about 1.2 gigawatts of battery storage currently in operation in the UK, but there's a strong development pipeline. I think there's about 10 gigawatts currently in various stages of the planning process in the UK. And we've seen a number of developments in the UK, so batteries participating in the capacity market, in the balancing market, providing grid ancillary services, as well as participating in the wholesale market. So we've got sort of quite a complex, in some respects, value stack and various revenue streams at play. But on top of that, there's, of course, factoring in state of charge management and cell degradation issues. And then switching to Europe, recent reports that I've seen suggest that 100 gigawatts of battery storage capacity will be needed in order for the EU to meet its current decarbonisation plans by 2030. So there's actually a lot to discuss, but perhaps to start with you, Tom, if you could perhaps talk us through how a market supporting batteries actually develops and some of the key features that you think are important in that development.
Absolutely. Thanks, Kirsty. Yeah, I've got some slides here, so we'll just put them up on screen, and we'll just chat through these materials. I think there's a lot of commentary that you would read on things like LinkedIn and on social media surrounding all of these themes, and each market has a slightly different take on some of the trends that we're explaining here. But yeah, I think most of the markets that are friendly to battery investment are going through the same sorts of drivers, I guess, seeing the same sorts of trends in things like policy targets driving renewables. Those same policy targets can also drive closure of conventional forms of flexibility. So, like the coal closures we're having in GB. We're seeing CCGT close across the board, old CCGT gas-fired power stations in Europe closing down, and those are your typical forms of flexibility that the grid operators use to keep the lights on, to provide really fast bursts of energy, to provide bulk megawatts when they're needed. So often those policy targets are closing technologies, and at the same time, those conventional technologies that do manage to stay on the bars, stay connected, are not running as much. So they're just not as available, because often when renewables are online, they force prices down low, and that means that it's not economically viable to operate these power stations. So we've obviously got a background of increasing intermittency from this renewable scale up, and then a closure of flexibility and unavailability of flexibility. On the right-hand side of this page, we're also showing something that's been very well documented, the reduction in lithium-ion cost. And lithium-ion is the main sort of chemistry used to build batteries, build utility-scale batteries. There's been an unanticipated cost reduction in the last 5 years, as you can see on the screen there. And further cost reductions are expected across the next decade. Obviously, it's mainly been driven by the electric vehicle industry. Indeed, electric vehicles are now becoming more affordable because of battery technology gains and advancements in the learning curve. At the moment, actually, interestingly, we're seeing a spike. In some of the deals we're working on, there's a spike in battery capex costs, and this is COVID inflationary pressure, we believe.
So do you think that is just COVID inflationary pressure, or do you think there's sort of quite a lot of stress on those supply chains and the supply demand with the increased demand for lithium and batteries? Do you think there's a more general thing, or is it a real COVID spike?
Yeah, I think it's a good question, and I think it's a mix of both. So you do have certain factories actually being closed in China, for example, and that's impacting not only battery prices but also solar prices. So there's clearly kind of a COVID angle there, but there's also the kind of tightening of supply, given that there is pressure from EV vehicles, battery supply as well. So and I think that will going by the figures that were recently published, you have about 5 or 6 gigafactories in Europe at the moment. That's increasing to about over I think tenfold over the next 10 years. About by 2030, you would see a capacity of about 660 gigawatt hours of gigafactories. So I think it's a short-term kind of blip, if you like, in the prices. But I think there are plans in train which would mean that the kind of cost reduction will carry on going forward.
Right.
Yeah. But an interesting observation we've made in all the markets we work in Europe is that when a market starts to become ready for batteries, they typically follow this sort of trend that we're showing on screen here. You don't often see a battery, but the first battery in a market hit the market and do lots of complex optimization across different revenue streams and lots of arbitrage, lots of balancing. What tends to happen, and we see this in Europe, but also we've seen it in the US as well, is that they are anchored around normally an ancillary service. So for the audience, ancillary services are almost like insurance products that the system operator holds. It's very common across most power market designs, and they are the services that kick in whenever you have a short-term supply interruption to keep the lights on, essentially. So one that's well known in the battery community is frequency regulation, which is a service that monitors the frequency of electricity. If the frequency dips, then megawatts are needed straight away, and those are obviously very well suited to batteries. So when we see the first batteries enter a system, they're normally chasing those revenues, those ancillary service revenues, and indeed some markets have actually made tenders or fairly kind of long-term, medium-term contracts, 4 years or so, to support the first wave of batteries. So in GB, we saw the EFR Enhanced Frequency Response Tender that was let in 2016, and that was 200 megawatts or so of batteries launched onto the system to help manage the frequency. Ireland had something similar with their DS3 program in 2019, and then late last year we had the Italian Fast Reserve Tender. So these tend to act as anchor revenue streams, contracted revenue streams. They get batteries through the door, and form a pretty investable business case for the battery. Other times, as we say, there may not be a long-term contracted opportunity, but the market dynamics mean prices are just very attractive in those services. So Benelux is a classic example at the moment. There's very high ancillary service prices there. Batteries swoop in, they displace expensive incumbents. There's a quick turnaround in market share. Suddenly batteries are taking half the market, the full market, and we see savings to consumers as a result because they push prices down. And what we said there is often that, we don't want to play it down. It's, obviously these services are technical and complex in their own right, but it often doesn't need optimization or complex trading capabilities that you would associate with a storage asset. So it's quite market, new entrant friendly. But over time, those services are often quite volume limited. They're small markets, and over time they become saturated. So what you tend to see happen, and we're seeing this in GB especially, but people are thinking about it in Ireland, and then on the continent too, is this kind of this full market access and optimization business model. And what we mean here is basically people developing that full market reach, so being able to access different markets at different times, optimize the battery across them, and do all the things that is associated with trading, so risk management, credit, controls to interface with the asset. And there's a variety of companies now offering those sorts of services, particularly in GB, which is probably the most advanced battery storage market in Europe.
And how long does it, if you start off from your sort of ancillary service starting point, and if that's the typical starting point, as you're saying, GB now we've got a sort of a better, optimized market or full market access, if you like. How long typically, if it's possible to say, does it take to transition across?
It's a good question, yeah, and I think if you will think about this to be a kind of continuous problem, I think the ancillary services kind of kickstart the battery storage market in these countries, but there's an ongoing need for fast frequency response services, and that demand continues to kind of increase. So, for example, in GB, it started off with the EFR tender, and then you had the FFR, which is a firm frequency response, but kind of a slower version of the EFR kind of service as such, kickstarting after the EFR tender was launched. So, and that lasted for a few years. And now you have dynamic containment, which is another ancillary services, which was launched last year. So you have different versions of these frequency response services, that keep kind of being launched. And National Grid and GB are looking at launching another, 3 to 4 services next year as well. So
they kind of drip fed, haven't they? They drip fed these services into the market. Yeah. And
because it's a new kind of space for National Grid as well.
So they're learning too.
They're learning too exactly that. So 2019, August 9th was it, when we had a blackout in London. That led to dynamic containment essentially, because the FFR service was a 10-second delay service, whereas they realized that is too long for blackouts to kind of potentially happen in a kind of a high wind scenario or a high renewable scenario.
And what we found in parallel was that the companies that were in the bottom right there, the utilities we call tech-savvy new entrants, oil and gas majors, they were involved in the left-hand side, but they took around probably about 2 years to upskill to do the right-hand side. So even though they do a lot of trading themselves, to develop the offtake contract with the commercial structure, to develop the controls to the battery and understand the status of the battery is actually no mean feat. It's quite a task. And so we saw that happen in parallel with the stuff Stuart was mentioning around FFR and over about a 2-year period. Now the question is, as we see other markets opening up with their ancillary services, and people are looking to offer the same sorts of services, full market services, whether that 2 years is like a fixed term or whether they'll be able to take the efficiency of what they've learned in GB and apply it faster. It's not going to be an overnight thing, but I think there will be
lessons learned.
There will be lessons learned for sure. And just to give you an example of what we mean by full market access, on this page we just have an example of what sort of revenues you'd be playing in across the day. So batteries are storage assets. At the top there we have traded markets. We mean the wholesale market essentially, and you can buy and sell power, buy low, sell high, make the spread. And that's exactly what you'd expect the battery to do. And then you can re-optimize. So if you bought power, you've got a full battery, but then you see another opportunity before you were intending to sell, then you can adjust the battery's position, make a bit more profit there. Alongside that, we have imbalance forecasting and capture. So is the system long or short, and does me adjusting my battery now make more profit for me and help the system? And that's a strategy deployed in GB, Benelux especially as well. Ancillary services, we talked about those, and then capacity markets. So sitting along the bottom, more capacity in nature, pounds or euros per kilowatt per year, and they can often form a relatively bankable revenue stream. Although we tend to see them amounted to smaller absolute payments for storage assets for more technical reasons.
And so, a quick question in terms of the UK particularly. We've had sort of quite a, shall we say, exciting time in the wholesale energy market. Now, clearly the way the technology is at the moment, from a battery's perspective, they can provide relatively short duration bursts of power. But looking at this optimization model, I presume for a number of the battery owners and operators, they've been really trying to use this model to really take advantage. It's been a sort of a good opportunity for them to really optimize, albeit that the technology inevitably limits them to some extent.
Yeah, exactly that. So, over the last 4 to 5 weeks, we've seen batteries move between, if you like, markets. So, DC and containment is a very popular service in GB, and you have certain EFA blocks, which are basically 4-hour blocks, and where batteries actually see value in those in those EFA blocks, they participate in DC, and then they would move out of DC to participate in energy markets.
Right.
Where they see more spreads. So what this chart really kind of shows you, very clearly is the kind of versatility of batteries. Where you mentioned about these kind of power focused services like ancillary services. That's what they can do as well. But some of these batteries now are also 1.5 hours, 2 hours, to even 4 hours now. Where they're taking multiple spreads in the market. Mm-hmm. So you are seeing slightly longer duration batteries that can more versatile and actually can tap into multiple revenues within the day itself.
Right. Okay.
And so this is the full market access model, and it's here to stay. There may be new services, there may be new markets, but the idea is being able to optimize and make the best decisions possible for that battery at a certain point in time to make the most money for the owner. And that is in play now, as we said. Now, what goes alongside that, obviously, is a contract. So typically, these services are offered by utilities, offered to third parties, or indeed other interests, not just utilities. But there'll be a contract underpinning the revenues. And what we've got here is a bit of a typical spectrum of what contracts could look like, and what we're actually seeing in practice. So on the left-hand side there, we have tolling agreements where you would basically keep an availability fee, and the route to market provider harbours all the market risk. And on the right-hand side, we have what we call an execution-only service, where the asset owner has all the market risk, picks up the phone basically, or has some other way of talking to the route to market provider and says, do this, do that. Now, we've seen all of those sorts of contracts in this market, but by far the most common are the revenue guarantees in blue there, and the optimization services. The revenue guarantees take the form of a bit like a floor price in a renewable PPA. Here, you tend to have a revenue guarantee because a price is not as relevant to a storage asset because it's all about the spread. So there we've seen some quite generous floor payments that we've just jotted there, £20 to £40 in the UK. We've seen similar levels being mooted in Europe. And that forms obviously quite a bankable revenue stream, provided the utility is credible themselves, has a decent credit rating themselves. Those agreements tend to be 5 to 10 years. A few more details there. And I mean, what you exchange in return for that security, of course, is a bit of the upside. So anything that the route to market provider earns above the floor will be subject to sharing at probably a more aggressive rate. Maybe Siva, you want to talk us through the optimization contracts and how they work?
Sure, yeah. So the optimization or kind of revenue sharing contract essentially rely on both parties taking the kind of equal amount of risk, so kind of incentivizing each other for being able to kind of generate maximum revenues, and then the off-taker gets kind of paid accordingly. So we've shown out here 4 potential kind of contracts, but this is basically a spectrum. You do see variations across this as well. But if you just think of a kind of typical optimization service contract, it'll be a percentage fee that the off-taker would charge, and the off-taker would then take a decision on where the battery should be operated.
Right.
So, we saw the chart before this, where the battery was kind of providing ancillary services in the early morning hours, and this could change depending upon the off-taker kind of visibility of value to different markets. But essentially, the kind of share of revenues would be fixed for a period of time. We mentioned here 1 or 2 years. We are now seeing that increasing as well. So we have seen revenue share guarantees of about 3 4 years as well, up to 7 years as well. So you are seeing that now being a lot more kind of longer term in that sense. So, but I think the kind of underlying message here is that with the ancillary services focused strategy, the off-taker role was not as important, but now to be able to kind of move between these value pools, the off-taker's capabilities become quite key, and then that has meant that some of the kind of off-taker fees as well have seen an increase.
So you're seeing a sort of difference depending on which sort of value pool you're in, how the revenue share is playing out.
So that's the other structure as well, where potentially for ancillary services, where the off-taker doesn't have that much of a role to play, the share could be much lower. But whereas if it's an arbitrage play, say for example in the imbalance markets or BM for that matter as well, then that share would be much higher. So basically kind of incentivizing the off-taker to develop capabilities to generate revenues in some of these difficult to access markets.
And so with all of these kind of different sort of ways in which your battery can be operated and the ways in which you may wish to optimize it, I guess underpinning all of this as well, when you originally sort of go to your EPC contractor and contract for your kit, you've got to have some idea at the back of your mind as to how it may work, because presumably warranties with respect to performance, etc., will be, you've got to have a view. So it's going all the way down sort of the chain.
Yeah. No, I think, I mean, I think maybe you could touch on warranties, but I mean, I guess the most recent example of that was the dynamic containment launch that Sumit mentioned late last year. Now that's a very fast responding service, and most batteries are very fast at responding, but some batteries that were already on the system were not fast enough, and so it's worth. I think we always say in any battery development team, a key role for a person in that team is to keep close to the market, close to the regs, close to market development, so that you can try to there's going to be some circumstances where you may come unstuck, but try to anticipate where the TSO is going, what is valued in the design of your asset. Touching on warranties.
No, exactly that. So you have that angle, which is about the new service that may be launched tomorrow, and kind of designing your battery storage system to be capable of providing those services going forward. The other is, of course, to kind of consider degradation, because the kind of the inherent issue, if you like, with batteries is degradation, which basically means that the capacity for it to kind of generate reduces over a period of time, depending upon its usage. So if a battery were to be used in DC, the degradation tends to be not as much compared to if it were to be doing energy arbitrage. So something called depth of discharge. So the depth of discharge for DC is much lower compared to in the energy markets. And so what typically tends to happen is the asset owner goes to an off-taker with that kind of constraint at the EPC and O&M contract has provided them, saying, well, at max, and most off-takers now, that most EPC and O&M contractors offer something called as a flexible warranty, which is so you have a total number of cycles that they want, but they also give you a max that you can do in a day. So, So if there are days where you have got better opportunities, then that's fine. You can take, you can cycle it more. And some days where you don't have those opportunities, just to make sure that the average, of course, can remain at a particular level. So, so I think the industry is kind of responding to the, if you like, the nuances of, batteries. And you do see a lot more innovative O&M contracts nowadays.
Interesting.
Yeah.
And I guess the reason we focus on these contracts, and of course that the industry does is because they are the interface for revenue, and of course one of the structures here with the guarantee of revenue helps with financing.
Yes.
We have seen I'd say probably the floor contracts directly target financing, and we have a few examples here. We won't rattle through all of them, but of successful debt raising processes, basically mainly in, I think these are all GB, aren't they? Yeah. And you can see over time they've generally grown in value. We've got project finance there, non-recourse debt, and we've also got syndicates of banks lending into public funds like Gresham House. So very exciting times. Helps obviously with the capex burden that all these sites will bring to the table as they get rolled out. So
this is interesting to see, because one of the a couple of comments that I've heard over the last couple of years, and I'd be really interested to hear if you come across this from investors, whether that's funds or lenders. They say a couple of things. First of all, there's the issue with respect to scale, because batteries are still quite small, and there's this view of, well, it's a lot of effort to diligence and understand what we've just heard is really quite a complex, or can be quite a complex sort of optimization revenue stack model. So there's an issue with scale and whether it merits their investment. And I think then there's this perception of merchant risk and the kind of the risk that is inherent in that kind of operation. Are you finding that lenders and investors are, well, clearly they are prepared to lend? Are they getting over those kind of concerns now?
Yeah, I think scale is one that I think is hopefully a legacy issue. With the changes in the UK, for example, on the planning thresholds, the NSIP planning threshold, we're now seeing hundreds of megawatts coming through. So it's more like a typical infrastructure process. So yes. Now I think on the merchant angle, it is interesting. I don't think when we look at these contracts, I don't think anyone should kid themselves that they're looking at well, it's difficult to pick an asset that's not volatile at the moment, but like a solar farm of the last 5-10 years. It's not a set and forget sort of revenue stream. As we've shown, there's a lot of optimization going on daily. You are exposed to the peaks and troughs. So while this may de-risk, some of the revenue to some degree, especially the floor price one, you are still dealing with an asset that is riding volatility. But the good news is that people are taking an intelligent view on those risks and taking the time to understand them, which is great to see. And I often compare it to where Europe was with actually thermal gas-fired plant 20 years ago. People that if 20 years ago, we didn't have a capacity market. There was a dash for gas. People were looking at the intrinsic value in power prices, the value you could make on the day in spot markets, and taking a sensible view on what are the potential downsides, just stress testing and making sure that the debt was sized appropriately. And I think people are taking the same sort of angle on this stuff. So it's good to see.
Definitely.
Yeah, I mean, kind of add to Tom's points, right? So scale has been kind of historically been a question mark, but recently, I think it was just yesterday, where you had Santander announcing an investment in or a kind of lending facility to TAG Energy, and the value came up to about 40% leverage. So not clearly the ones that we've seen, or you kind of getting excited about. It's not over 50%, but you still have about 40% leverage, and the value of that particular transaction was about 6 million, if I'm not mistaken. So you have relatively small amount, but you also see numbers like about 30 million, which is done with Close Brothers and PGT recently, that specific green technologies. And so you are having certain players who are happy to kind of take that range of, if you like, lending, right from 500 million single-digit numbers to a few tens of millions.
So I think so that's that's a quick kind of history of what we've seen in GB particularly, but also the trends that we're seeing in European markets. I mean, what we've kind of set out on this page is some key considerations that we always try and prompt our clients to think about when they're in DD processes, looking at making an investment or lending into a market.
Capacity market one's an interesting one because I know that's been an important part. Certainly, it's not been without its issues in terms of batteries participating in the capacity market. But actually, some of the discussions I'm hearing at the moment, there was a lot of sort of angst, I think, at the time about derating and how derating factors were sort of applied across the piece. And I think I'm also sort of hearing discussion around interconnectors participating in the capacity market and it not necessarily being a particularly level playing field. Is that a fair comment, or?
Yeah, I think
probably putting you on the spot here.
Well, I think interconnectors have always had a role in the capacity market. I think since the first auction, I'm pretty sure, and they're derated, with a particular methodology to make sure that it reflects their contribution. I think that came from the fact that when the UK got its capacity market approval, part of the conditions were to allow foreign capacity to participate. The two ways of doing that are either to have a cross-border capacity market where literally individual plants in say France would bid into the market, or just give the cable itself a contract. So they went with the latter. So there's always been a bit of tension there, I think, because it's obviously a big source of capacity. But I think the interesting question about capacity markets is, as you say, capacity is derated based on its contribution to essentially peak demand, adequacy. But of course, when we have these issues on the system, like in September, like August 2019, feels ages ago now, but when we have those issues, it's not in peak conditions. It's not 5 p.m. January Tuesday evening. It's when the system is quite bouncy, when we've got lots of maybe low demand and high renewables. And so the question is kind of, what do we mean by it? What are we guaranteeing here, and why are we still getting issues? And maybe we should be rewarding more flexible plant in the capacity market differently to how we are currently. And I think that's a really interesting question for policymakers to take forward. So I think we mentioned the reg change. Yeah, definitely. Are there any reg changes impacting the business case? Obviously, do your reg DD. Some of the other considerations here, like how mature is the market, how much learning is needed to jump to that full market optimization, not just from the ancillary service, because as we say there, the ancillary service will become saturated. Yeah. When it is saturated, is there enough revenue in those other revenue streams to support a decent business case?
What about the floor payment? That's quite interesting, because you'd sort of think, of course a floor payment would be necessary for financing, but I guess perhaps not. So
floor payments, I think I could summarise the market attitude to this as floor payments great for increasing leverage, but not so good from an equity perspective in terms of what you're giving back on the upside. The question is, how much debt can you sensibly get into a project without the floor? And that's that CCGT sort of mentality, I guess. And one other one we'd like to pull out here is actually just the one at the bottom right, the route to market provider, because we come from a background of asset due diligence and helping people understand the value in an asset and that asset's intrinsic value versus the rest of the market. But when it comes to this sort of stuff that we're looking at, clearly the value is in actually the people, the firm that are optimizing this asset day to day. So almost half of the DD is in the route to market provider, their track record, how resilient and robust is the contract sitting underneath all these services. How do you benchmark them as you go? If you have got a 2-3 year contract with them, how do you pause and say, how have you done? Why did you make those decisions? And that should all be part of the DD process, really.
Yes.
Yeah. I mean, I think as the markets move towards more real time, you're also seeing players actually making those decisions on a regular basis. So it's quite transparent in the sense and see how people are making decisions and have we got it right or not. And what, so yes, you do have leaderboards, and we have our own way of analysing the route to market providers' performance, but that is quite key to make sure that the business case stacks up.
So it's quite interesting, isn't it, where it's gone from, as you say, asset diligence to more of a service performance metric. It's almost a bit like a back in the day sort of O&M providers and some of the performance indicators or metrics you included in contracts for them, but obviously taking it one step further to really quite a complex revenue stack and an optimization of the asset.
Exactly.
That's been incredibly interesting. Thank you very much indeed. I think we're up in terms of our time, but thank you both very much again for joining and sharing your insights and contributing to a really informative discussion. Thank you very much.
Thanks for having us.
Thank you.
Thank you.
Thank you.